Welcome to our beginner's masterclass on investing in the stock market. If you've ever wondered how people grow their wealth through stocks or felt too intimidated to start, this session is for you. By the end of this lesson, you'll know what the stock market is, how investing works, and how to begin your journey step by step. At its core, the stock market is where people buy and sell ownership in companies. When you buy a share, you're not just buying a number on a screen, you're buying a piece of a real business. You own part of its profits, its growth, and its story. Companies issue shares to raise money, and investors buy those shares hoping the company's value will increase. The stock market connects businesses that need capital to grow with investors who want their money to work for them. Investing in stocks is one of the most effective ways to build wealth over time. Historically, the stock market has provided 7 to 10% average annual returns, higher than savings accounts, gold, or real estate. When you invest in strong businesses, you benefit from compound growth. Your profits generate more profits over time. For example, if you invest $1,000 at a 10% annual return, in 20 years it grows to over $6,700 without adding a single extra dollar. That's the power of compounding, and it's why the best investors think in decades, not days. Before you begin, it's important to separate two terms people often confuse: trading and investing. Trading means buying and selling stocks frequently, trying to profit from short-term price changes. Investing means buying stocks to hold for years, focusing on business growth and long-term value. Trading is like sprinting, exciting but risky. Investing is like marathon running, slow, steady, and powerful. As a beginner, start as an investor, not a trader. You'll learn discipline, patience, and the true value of ownership.
There are two main ways to earn money from stocks. First, capital appreciation. When a company grows, its share price rises. If you buy a stock at $50 and sell it later at $75, you've made a $25 gain per share. Second, dividends. Some companies share profits with investors, giving you a small paycheck just for owning the stock. Combine price growth and dividends, and you have a powerful wealth-building machine. Let's break down how beginners can start investing step by step. Step 1. Define your financial goals. Ask yourself why you're investing. How long can you keep this money invested? What level of risk can you handle? Investing without a goal is like sailing without a destination. Set clear objectives. Step 2. Learn the basics. Understand key terms like stock, portfolio, and index. Diversification is key. Spreading investments across different sectors reduces risk. Step 3. Open a brokerage account. This is your gateway to the stock market. Choose a reliable broker with low fees and educational tools. Examples include Fidelity and Robinhood. Complete the KYC process, deposit funds, and you're ready to go. Step 4. Decide what to invest in. Start simple as a beginner. You can choose individual stocks, ETFs, or mutual funds. ETFs are often the best starting point. Step 5. Start small. You don't need a lot of money to begin. Even $50 or $100 a month can grow significantly over time. Consistency is key. Step 6. Build a diversified portfolio. Never put all your money in one company. Diversify across sectors, regions, and asset types. It's your safety net against volatility.
Check your investments monthly, not daily. Short-term market movements? They're just noise. As a long-term investor, focus on trends, not drama. Remember, time in the market beats timing the market. Every investment carries risk, even the safest ones. Stock prices rise and fall daily due to news and events. But here's the truth. Volatility is normal. In the short term, markets fluctuate. In the long term, they grow. To handle this, follow 3 golden rules. Invest only what you won't need immediately. Keep an emergency fund for peace of mind. Stay invested through market cycles, no matter what. Panic selling during downturns? That's a mistake. You might miss the biggest recoveries that way. Now, let's talk about the power of compounding. Einstein called compound interest the eighth wonder of the world. Invest $200 a month at 8% per year, and after 30 years, you'll have over $270,000. That's with just a $72,000 contribution. Compounding rewards patience, so stay invested. Time, not timing, is your most powerful ally. Successful investors aren't magicians. They're disciplined. They invest regularly, not based on emotions. Reinvest dividends instead of spending them. Keep learning about companies, markets, and trends. Avoid speculation. Don't buy stocks based on hype. Think long-term, years, not weeks. Investing isn't about predicting the future. It's about preparing for it. Let's talk about the common traps beginners fall into when investing. Chasing after those hot stocks everyone raves about online. Selling too soon out of fear. Investing without doing your homework. Ignoring those pesky fees and taxes. Trying to time the market like a pro. Avoiding these mistakes can put you ahead of 80% of new investors. The real journey of investing isn't just about the money. It's about your mindset. Patience, curiosity, and discipline are your best friends here. Keep learning. Read annual reports, study economic trends, and see how global events impact companies. You don't need to be a financial whiz. Just be consistent, rational, and open-minded. Every investor starts as a beginner, unsure, curious, hopeful. The secret isn't predicting the next big stock. It's about staying steady when others panic, keeping your learning hat on when others quit, and letting time do the heavy lifting. So, start today, even with that first small investment. Every empire of wealth began with one share, one idea, and one decision to take that first step. Welcome back to our stock market masterclass. Last time, we covered the basics of investing, what stocks are, and why patience is key. Today, we're diving into how to build your first real investment portfolio. By the end of this lesson, you'll know how to structure and maintain a portfolio like a pro, even if you're starting small. Think of your investment portfolio as a garden. Each plant is an investment. Some grow fast, some slow, but together they create balance. A portfolio is your collection of investments: stocks, ETFs, bonds, and cash reserves. Your goal is to design a garden that thrives through sunshine and storms. A portfolio has two main jobs: growth and protection. Growth increases your wealth over time, while protection reduces losses when markets fall. Balancing these goals is called risk management. Too much risk can burn your capital, while too little means your money won't grow. Your portfolio sits at the intersection of these two forces. Asset allocation is deciding what percentage of your money goes into each investment type. The classic framework divides assets into equities, bonds, and cash. Equities are your growth engine. Bonds provide stability, and cash offers safety. A simple rule is the rule of 100. Subtract your age from 100 to find the percentage you can allocate to stocks. For example, if you're 30, a balanced mix would be 70 to stocks and 30% bonds. This isn't a strict law, it's just a starting point to match risk with your time horizon. For beginners, the core of your portfolio should be broad market ETFs. Think of the S&P 500 ETF, like SPY or VOO, which invests in 500 leading US companies. Then there's the Total Market ETF, VTI, covering large, mid, and small caps. Don't forget about the international ETF, like VXESUS or ISIS for global exposure. These ETFs instantly diversify your holdings, lowering risk while aiming for long-term returns. Once your foundation is set, consider adding sector-specific ETFs, like technology or healthcare. These are like nutrients that enhance your core portfolio. After building your core, you can add individual stocks for potential extra growth. But keep a structure. Limit individual stocks to 20 to 30% of your portfolio. Research each company's earnings, competitive advantage, and financial health before buying. For example, in a 5,000 portfolio, you might have $3,500 in ETFs, $1,000 in individual stocks, and $500 in cash reserve. This keeps you diversified and protected. Diversification is your first line of defense against loss. Spread your money across sectors like technology, healthcare, and finance. Also consider regions: US, Europe, Asia, and emerging markets. And don't forget asset types: stocks, bonds, ETFs, and cash. When one area underperforms, another often gains, balancing your returns. Remember, diversification doesn't eliminate risk, it manages it. Over time, some investments grow faster than others, changing your original allocation. That's where rebalancing comes in, returning your portfolio to its planned weights. For example, if you planned 70% stocks and 30% bonds, and stocks grew to 80%, you'd sell some stocks and add to bonds. Do this once or twice a year to keep your risk under control and profits consistent. Most people wait for the perfect moment to invest, and in doing so, they miss out on great opportunities. Instead, consider dollar cost averaging. Invest a fixed amount regularly, whether monthly or weekly. When prices are high, you buy fewer shares. When they're low, you buy more. This strategy averages your cost and helps reduce emotional stress. It's one of the most powerful techniques for long-term success. Remember, numbers matter, but so does your mindset. Greed can push you to chase rising stocks, while fear might make you sell at the bottom. Successful investors train their emotions like athletes train their muscles. Stick to your plan, not your feelings. Markets reward discipline, not drama. Now it's time to design your own portfolio blueprint. First, think about your goals. Is it retirement, education, or freedom? Next, decide how to allocate your funds. What percentage will go into stocks, bonds, and cash? Then, select your core ETFs and any optional stocks you want to include. Don't forget to automate your monthly investments. Make it easy for yourself. Finally, review your portfolio annually and rebalance as needed. Your plan is your anchor. Stick to it through both bull and bear markets. Every portfolio tells a story of patience, learning, and courage. You've learned the basics of stocks, and now you've built your first portfolio. From here on out, your job is simple. Stay consistent, keep investing, and keep learning. The greatest returns in the stock market don't come from perfect timing. They come from a lifetime of discipline and belief in the future.